Hi, and welcome to F.Y.I. This is the second part of the financial jargon series, and today I'm covering four new terms, beginning with blue chip. Blue chip refers to a company or the shares of a company which is financially sound and has consistently performed well, hence proving its reliability. Examples of blue chip companies are Reliance, Tata, Infosys, HDFC Bank, and ICICI Bank. Here are a few reasons why one should consider investing in blue chip stocks. Number one, consistent returns. Number two, low risks involved. Number three, high dividend payout. And number four, decent returns during bearish market. Since the companies are reliable, it is considered to be a safe investment with guaranteed returns. Some characteristics of blue chip stocks are industry leader, a dependable business model, a proven track record, and a history of delivering strong returns over the long term. Since the companies are reputable and the risks involved are also relatively low, these stocks are definitely highly priced. Finally, let's wrap up blue chip stocks by discussing a few disadvantages. Low volatility, low returns, conservative at times, high value, slow and steady growth, and high downside risk. Let's move on to our second financial jargon, liquidity. I would very simply define it as the ability to get cash in hand. Liquid assets are extremely useful, especially in times of financial need. For example, liquidating stocks to get cash in hand. Alternatively, we can define liquidity as the ease with which an asset or security or investment can be converted to something tangible, that is cash. In relation to liquidity, we can categorize assets as liquid assets and non-liquid assets. Liquid assets or a liquid investment is something which can be cashed at a short notice without losing value, for example, bonds and mutual funds and stocks. On the other hand, non-liquid assets cannot be cashed easily, and if cashed, involve the loss of investment, for example, real estate and antiques, art, and furniture. Cash is the most liquid of all assets and is the medium of exchange. In the economy, cash is the most liquid of all assets. Stocks are examples of semi liquid assets, and houses and cars are examples of illiquid assets. Now I present to you our third term, bull market. A bull market marks a 20% rise in stock prices, which is followed by two previous 20% declines. In general, a bull market is characterized by optimism and rising prices. A bull thrusts its horns into the air, which is personified by the movement of a bull market, hence the name. A bull market is a clear signal of a favorable economy. It indicates that the markets are on an upward slope, as is depicted by the graph. The prices of shares and investments in the market are rising, and hence investors are extremely encouraged and eager to buy. In the case of equity markets, the bull market denotes a rise in the prices of companies' shares. Last, but certainly not least, let's tackle bear market. A bear market is a condition in which the market is down by 20% for a 2-month period at the least. It results in the fall of the GDP of the country. A bear market is synonymous as a seller's market. The investors want to sell instead of buy, and the most famous example of a bear market is the Great Depression. A bear swipes its paws downward, which is a metaphor for the movement of a bear market. A bear market is a sign of a receding economy. It is characterized by a fall in investor confidence and, of course, falling stock prices, as is depicted by the graph. Some common trading terms to be known. Number one, bearish, being pessimistic about a stock's value. Number two, on the contrary, bullish, being optimistic about a stock's value or being long. Number three, long, purchasing or owning a stock. And number four, shorting, selling a stock early with the hopes of buying it back later at a lower price.